CNBC-TV18.
Hello and welcome to this special State of the Economy discussion. The December CPI number is a very pleasant reading of 5.72%. The CNBC-TV18 poll was 5.84%, and there were several people on the street with even a 6% reading. So this is an extremely pleasant number. But let me tell you, the even more pleasant number is the industrial output number, which has come in at 7.1%. This is for the month of November. The CNBC-TV18 poll didn't even make it to 3%. There were some people with 5% on the street, but a 7.1% IIP reading is an extremely pleasant number, and it has been driven to a large extent by manufacturing getting back its mojo and kicking in with a 6.1% rise. So that's again a very one minute. Let me check. Yeah. Manufacturing comes in with a 6.1% rise. Why even mining has done reasonably well at 9.7%. But I think the important point is the overall IIP number is an extremely pleasant number at 7.1%. So that's good, but we have to concentrate more on the CPI numbers. And the CPI, I gave you the headline at 5.72. A large part of it is because of the easing of food inflation. Food inflation has come in at 4.19%. Our fear was that it would come in at 4.67, which was exactly the number in December. Everyone knew that vegetables would go down, and now we have the number for it. Veggie inflation is down by about 12% in the month of December. So steep fall. The fear was that it would be compensated by a rise in cereals, but that's not happened. We have seen a fall in the production of, in the prices of food. It's 4.19 versus 4.67. So, you know, the month-on-month fall in the food price index, that is December from November levels, is 1.6%, which is very good. So we have actually a combination of good news. Growth is higher than our poll estimated, and inflation is lower than what our poll estimated. So all ends up very good number coming in. I'll just read out a few of the CPI numbers because they're more important. Cereals prices are indeed higher. It's a 13.79% increase, but maybe the fears were it would be even worse, especially month on month. Meat and fish 5% higher year on year. Eggs up 6.9%, milk up 8.5%. All this is on expected lines. Oils and fats have fallen, and they were expected to 0.5% low, only rise year on year. Fruits are up only 2%. That was a big positive. And vegetables down 15% year on year. And I think 12% month on month is the big positive. Pulses are not up much. That again is a positive, up 3.89%. Sugar is flat, just 0.6% higher. And that explains why you have a fairly benign food inflation number. Let me see if I can get you some of the services numbers. That is, personal care is still high at 8.2%. Education up 5.9%. Recreation up 5.17%. Transport and communication 4.88%. Health 6.15%. From the look of it, I think the core inflation is going to be high. It is going to be at least 6%, if not higher, because the services inflation has come in fairly strong. With that, we can go to the IIP numbers. IIP numbers, as I told you, a strong set with a 7.1% overall growth, and manufacturing itself coming in pretty strong at 9.7%. Sorry, at 6.1%, 9.7% is mining. But overall, a very strong show. Let me get our experts. We have Rupa Rege with us. Rupa Rege, Nitsure of L&T Finance, joining us. We have other economists as well. Rupa, if I may come to you first. Okay, we have them all. Aditi, Nyar, Anubhuti, Sahay, and Amandeep, Chopra. Rupa, first, your thoughts. CPI number 5.7 looks very benign.
Yes, certainly. I was expecting it to be around 5.8. So it's a pleasant surprise.
But as you rightly pointed out, it's primarily triggered by benign vegetable inflation, perishables inflation, and also to some extent the base effect is kicking in. But on the whole, you see, this gives raises my optimism for food inflation trajectory in the fourth quarter, because Rabi crop is also strong. So going ahead, we may not see any ugly print on food inflation front.
Okay. Well, now we've got the core inflation number, Rupa, and that has come in at 6.1%. So, Anubhuti, Sahay, how much should we be happy about this 5.72% CPI number? Because core is still trending higher, and in the last policy, the Reserve Bank made it a point to say that they are also waiting to see core inflation come down and that its persistence is irking them. Your thoughts?
Lata, I think the headline number is still important. You are very right that core is still at 6.1%, and that will be a concern for the RBI. But I think we can draw some comfort that food inflation is edging lower, because there is always a second round impact on core if food would have stayed elevated. So I think there is some good news on that part, because we are seeing some moderation in food prices in a lot of other components besides vegetables. So I would say, yes, there is good news and we should acknowledge it. From the RBI's perspective, will they really look at things very differently for FY24, given the recent positive surprise? My sense is it's still too early. We have to see how core inflation finally plays out, especially in FY24, because right now the commodity prices are very benign. We have to see how they finally play out in FY24, especially in the second half, when probably the US recession, China slowdown, everything is behind us. And that's the time when it will be a good time to take a strong call that inflation is lower for longer, rather than just taking it right now where it's coming for just few months, and the certainty on the sustenance of this trend still remains under question.
Okay, I think we are getting only a 6.1% inflation for the third quarter. Isn't that much less than what the Reserve Bank told us? Aditi, Nyar, your thoughts on CPI?
Yeah, Lata, definitely come in below our expectation. We had penciled in 5.9%, and the downside is entirely coming in on account of food. Now, while core is going to remain elevated, I agree. But even if we look at the food component, which is a large component of the CPI, and we look at the month-on-month trends for the early part of January as well, that's also positive. So as far as the momentum is concerned for food inflation, we're seeing the high-frequency prices coming down for number of items, particularly again on the vegetable side. And also, as Rupa pointed out, the Rabi sowing trends are healthy. The reservoir levels are quite healthy. So the outlook for food inflation looks a lot better than what we would have thought at the end of September, for instance, when we really didn't know what to make of the very heavy rainfall. So I think from that point of view, even if it's a downside coming in from food into the CPI headline number, that's still something that we should celebrate. Okay. And yes, the Q3 numbers will end up running quite a bit lower than...
Yeah, I just checked what the Reserve Bank said. The Reserve Bank had estimated Q3 CPI at 6.6%. I mean, we knew when the November inflation came itself that, we won't get to 6.6. But now the actual number is 6.1. So that's a full 0.5 percentage point less than what the Reserve Bank forecast. So it looks like the full year number will also have to be revised. They were working with a full year number of 6.7. That also is likely to come lower. Before I come to Amandeep, for one last time to you, Rupa, on inflation, do you think now the fourth quarter number will also have to be revised lower? The Reserve Bank's forecast was 5.9. Are we likely to get much lower than that?
Yes, because they were projecting it to be closer to 6% handle, but I think it will be below 6% for the fourth quarter. And they were looking at 5% handle for the first quarter of FY24. There also, there is a very high likelihood that it will slip below 5%. Okay. So I feel going ahead, actually, MPC will pay more attention to cyclical slowdown than inflation worries.
Okay, now Amandeep, what will the market say? Isn't this coming as a very pleasant surprise?
Yes, Lata, it is. I think we've had 2 consecutive months of actual inflation print being well below the consensus estimate. So I guess this is again another driver of the rally that we've seen over the last few days. I think you could actually see again maybe a few more basis point of rally from here on. But I would actually venture out to say that maybe a good part of the inflation trend seems to be already priced in by the markets. So the focus now, I guess, will shift to Q4 of current financial year. And since we've already seen an undershoot as far as RBI's inflation trajectory is concerned, I think the 5.9 number will now start getting questioned, and you may actually start looking at statements coming in which could actually focus on inflation more certainly coming close to 5%, which I think will be very comforting, both in terms of the
Amandeep,
subsequent.
now should we question how many rate hikes we have? We are at 6 quarter. Are we even having a rate hike in Feb? Will that be the last if it is? What are your rate hike expectations now?
I don't think we've really changed our expectations. We still expect, another rate hike in Feb and repo rate going up to 6.5%. Will that be under question with this recent inflation print? I don't think so.
Okay.
If you look at the core continues to be sticky. And as we've seen, it's just moved up marginally above 6 as well. So I think, the fact that RBI brought into question and focused the core inflation will remain an essential, variable for them to look at. Now, while we may sort of look at the current trend being somewhat positive for the markets, let's not forget that, as we go well into next financial year, how does China's, economy opening up, will they provide any stimulus or not? And its implications on commodities will also be influencing some of these positive trends we see in inflation. So I think it's too early to call a definitive slowdown or decline in inflation. So I think that is one aspect which will keep the markets a bit uncertain.
Okay.
How China impacts global commodity prices, particularly energy. And the second, I guess, a factor which markets are watching out today at least is also US CPI print. So that I think will be again an important driver of how our expectations from both RBI as well as Fed sort of plays out in the subsequent quarter.
Okay, actually, with that, all right, let me just get a quick monosyllabic vote from the other two as well. In terms of rate hike, Anubhuti, what from the RBI now?
Final rate hike of 25 basis points in Feb.
In Feb. Aditi?
I don't think we can rule out a pause.
Okay. Oh, very good. That's excellent. And Rupa, you would go with a hike in Feb?
No, even I am expecting them to take a pause.
Okay, so this is an equally divided house. Amandeep and Anubhuti expecting that there could be one and done, and two others believing that there could actually be a pause. As it is, we have seen yields in the market fall, and this could clearly trigger some bit of a rally. Would it, Amandeep, tomorrow? You go to 7 quarter, 7.2? Or will it all depend on what US tells us?
I think there is still, the overhang of US CPI print, which could affect the sentiments tomorrow.
Okay.
Then we also have another factor, which is, the new auction tomorrow.
Oh, yes.
That's a 30,000 crore supply, which is fairly large. So I would think that markets have more or less already positioned for a weaker inflation print. And that's why, like I mentioned, over the last 3 days, we've seen, the 10-year sort of trend lower, which is also incidentally, the same sentiment that's being reflected in the US as well. I think they are also expecting a much softer CPI print in the US. So let's wait and watch if there was any, alternate or negative surprise there.
Yep.
Then maybe we could see some of the gains we've seen over the last few days, be given up.
Our editor is going with the headline "Double Delight," and he obviously means inflation lower than expected, growth, industrial output higher than expected. It could be a triple delight as well when the US numbers come. But I want to discuss the second part of the delight, the IIP number coming in far stronger than expected at 7.1%. And let me tell you, the internals are even more pleasing. If you remember, in the core sector, we saw a power output number in November that was lower than October. That's reversed in IIP. In terms of output, power sector is higher than what it was in October. The index number is higher. I'll just give you the number in a minute. We have the index number at 148 compared to 131. The index number is 191 compared to 160. So clearly the power output has gone up. But more importantly, it's consumer durables and non-durables where the November production is far higher than the October production. For consumer non-durables, it's 161 compared to 129.7. I mean, October output does go down because it's a festive month. There was a fear that the slowdown will continue, but it looks like output is very good. We had some idea that consumer durables would do well when we saw the auto sales, and that also has gone up from 106 index number to 112 index number. That is consumer durables. Consumer non-durables, which was sulking for the better part, has also done very well. Month on month, 129.7, rising to 161.1. And now I'll give you the year-on-year numbers, which also are very good. Consumer non-durables have grown by 8.9% year-on-year, and consumer durables by 5.1%. Those are, of course, more market-sensitive numbers, and that's why I'm giving them first. Capital goods also growing very well at 20.7. So this is an all-round growth number. Power is good, manufacturing good, mining good, consumer durables, consumer non-durables, capital goods. I can't find one thing to rue about in the IIP number. So it's over to you, economists. Anubhuti, your thoughts?
It's definitely far better than what we expected. We were looking at a 3.9% IIP number with manufacturing at around 2.5%. And manufacturing on its own has come at 6% plus. So it's definitely an encouraging number. And if I look at it purely from the segment perspective, there is a clear improvement across the board. To some extent, we expected a double-digit growth in capital goods of around 15% because there is a favorable base effect. But if I caught it correctly, you said 20%. That's
yes.
Even better. And the bigger part is on the consumer side, especially on the consumer non-durables. I think if we look at the IIP number for November and adjust it against the October contraction and assume that even if we don't see a high single-digit growth in December, but the quarterly average is likely to be far better than Q2. Okay. And from the manufacturing sector perspective, which was in a -4% contraction in the second quarter, we are likely to see a reversal in signs. I think we might actually see a growth of plus 3 to 4% or even higher because WPI is also lower. So it's definitely a positive number. We'll just have to watch out how much of it sustains for the last quarter, because if we look and hear commentaries around us, they are talking about some moderation in demand.
Okay. Now, I wantonly read the month on month because year on year we could still complain that last year we were still, in between the Delta and Omicron waves, and therefore, whether the low base makes the current November look good. No, November is good even compared to the previous month, October, which was a fairly robust month. And by the way, just by way of detail, the October -4 has gotten revised to -4.2. So it's a little worse than we thought. But Aditi, Nyar, very quickly, what would you make of the IIP number? Pleasing?
Pleasing, definitely. It's higher than what we had forecast. But just want to point out one thing, that October and November should never be seen in isolation because Diwali keeps sort of shifting back and forth. So if we average these 2 months together, we're still looking at a low single-digit growth only. So things are not as bad as what the October number told us, but they're also not as great as what the November number is telling us in isolation. And I think that's something we need to keep in mind. For December, I would definitely expect this number to slow down a little bit. And the export-related impact will possibly intensify a little bit more in the current quarter. So that's something to keep in mind. We still believe that GDP growth is going to average about 5%, maybe just a shade under 5% in the second half of this year. So again, just to go back to the October numbers, I mean, those were really negatively impacted because we had an early Diwali and things are not as bad as what those numbers told us.
Okay. But it's good to see that things have picked up a lot, and capital goods is good. Even infra has grown 12.8%. It's only basic and primary goods which are at about 3-4%, which we can take because everything else has done very well. Capital goods 20.7, infrastructure 12.4, consumer durables 5.1, and consumer non-durables 8.9. Like you already know, manufacturing overall 6.1, mining 9.5, and electricity as well. I think it was 12.7. So it's really an all-round kind of growth. Last word from you, Rupa.
See, Lata, I would like to reiterate and strengthen what Aditi has said, because, you know, even if you take seasonally adjusted month-on-month growth, it is positive, but it is quite low. Base effect has really distorted the picture. Even my growth projection was 6.3%, which was on the higher side. But I know what the statistical base effect primarily has caused that. If you look at this whole consumption good story in India, point is that you see the consumption patterns are tilted towards higher income groups. So point is that even in passenger vehicle sales, you see good demand for passenger cars and high-end vehicles, but negative growth numbers for two-wheelers, and within that also for motorcycles and mopeds. Similarly, in housing segment, rate sensitive segment, you see very good demand holding for say luxury or premium flats, but not for affordable housing and all. So if you take seasonally adjusted sequential trends, then you will see some moderation in the month of December, January, etc. Given that unemployment rate is also very high. Okay. I think sooner than later, MPC will have to concentrate more on growth aspects than on inflation worries.
Fair enough. Okay, that's bringing us back to reality and saying that if you looked at the average, growth actually needs support in terms of monetary policy. But the Reserve Bank will love to be in this dilemma where the inflation number has come in lower than expected and the growth number higher than expected. Amandeep, Anubhuti, Aditi and Rupa, thank you very much for joining us with your thoughts. The wrap on the state of the from the state of the economy data is that we have definitely seen the last of strong inflation. The average for the quarter itself is just going to be 6.1 against a Reserve Bank estimate of 6.6. And it's been an across-the-board fall. Importantly, even food products is only up 4.1 compared to 4.67 in the previous month. Our only worry would be core inflation. Growth, the numbers are much better than what we expected, all-round growth. Well, with that, let me hand it over to Rima, who's been waiting by, because we've got the HCL Tech numbers, and it looks like it's the third company after TCS and Infosys to give us a beat on revenues. And I think the unusual part is it's also a beat on margins, but I'll leave it to Rima to tell you the details. Rima, take it away.
HCL Tech has reported a revenue and a margin beat. Now, this is the third consecutive IT company which has reported a revenue beat this time. Both Infi and TCS had reported a strong top line, and now it's HCL Tech. HCL Tech's dollar revenue growth has come in at 5.3%, much ahead of expectations of 3.5%. Constant currency revenue growth of 5% is also looking solid, 13.1% on a year-on-year basis. Margins is where HCL Tech has beaten its peers in terms of a surprise. Now remember, both Infi and TCS margins missed the mark. But for HCL Tech, margins have expanded by 165 basis points to come in at 19.6%, and this is much ahead of consensus expectations. A quick word on the full year guidance. FY23 revenue guidance is now seen between 13.5% to 14%. The earlier guidance was 13.5% to 14.5%. But in December, the company said that growth rates will be at the lower end of their guided band. So that's what they've done. They've tweaked the guidance and they've said that it'll be 13.5% to 14%. Services revenue growth between 16 to 16.5%, and EBIT margin guidance band too has been narrowed towards the lower end of the earlier band, and now it stands at 18 to 18.5%. The deal wins are steady on a quarter-on-quarter basis, coming in at $2.35 billion. It's up 10% year-on-year. So it's a strong showing from HCL Tech, a beat on revenues and margins. FY23 guidance has been tweaked, but that's in line with market expectations and the company's own updated performance in December.
Thank you very much, Rima, for that photo finish because we were running out of time. We are wrapping up with positive news everywhere. HCL Tech numbers better than expected on revenue and margins, and inflation and IIP also pleasing numbers. We have to go into a break, but stay tuned. There's lots more news and updates awaiting you.